Good morning. Let's get started with chapter 6. This is the second video. We have 3 learning objectives in this chapter. We have already gone over the first 2 learning objectives in the previous video. So let's get started with this one over here. To recap, our learning objective for the first video was to discuss how to classify and determine the inventory, and second, to apply the inventory cost flow methods and discuss their financial effects. So in the first learning objective, again, to quickly recap, we had looked at the difference between a merchandising business and a manufacturing business, what their inventory looks like, what items we include or not include in inventory. In the second learning objective, we had looked at the different cost flow methods. We looked at FIFO, LIFO, average cost, and also talked about specific identification method. And we had seen what the effect would be on the income statement if each of these 4 methods were to be applied for the exact same example. Now we are moving on to the third learning objective, and that would be to explain how the statement presentation analysis of inventory would work. So let's get started first with presentation. Again, as was mentioned in the previous video, inventory is always classified as a current asset. It's immediately below receivables. Remember, current assets are listed in the order of liquidity. So cash is always the first item, receivables is the second item, and third item would be inventory. In the multi-step income statement, we saw this in the previous video, cost of goods sold is subtracted from net sales. So in the income statement, right up on top, net sales is calculated as gross sales less your returns, less your discount. Net sales minus your cost of goods sold gives you your gross profit. So that's where those 2 items are going to be presented. We also need additional information about inventory in our balance sheet. So what else needs to be disclosed? What are the major classifications of inventory that you have? What's the basis of accounting you have used? What's the costing method you have used? And the costing method we went over in the last class, in the last video, and the basis of accounting we're going to now look in the next slide, what that means. So to start with, inventory is always valued at cost. However, what happens if the cost of the inventory is at any given point of time, the cost of inventory is higher than the market value of the inventory. So that becomes a problem, and we'll have to see what we need to do in terms of adjustment at the end of the year. Remember, inventory is an asset. Someone who's using these financial statements to predict the future cash flows looks at our inventory and says, this is what I'm going to sell in the future, and I'm going to earn revenues. That's going to be a source of cash flows. So now we are talking about that process being impaired because of some reason. So we first find out our cost using one of the cost flow methods, whether it's specific identification, FIFO, LIFO, or average cost. We already know what the cost of our inventory is at the end of the year. Now, if the value of that inventory goes down, then we are allowed to write down, which means we basically take a loss even before we sell the inventory, we recognize it. Now, we're going to compare it with market. So here's something we need to look at very carefully. When we are talking about market, we're talking about replacement cost. What would it cost me to replace the inventory that I have? So as an example, if I have pens in my inventory, each pen I paid $1. Normal expectation is I'm going to, let's say, sell it for $1.50. That's a 50-cent profit. Probably not close to reality, but let's just say as an example. Now, if at December 31st year end, if I can buy that same inventory of pens for 80 cents a piece, that's 20 cents less, most probably the selling price of the inventory is also going to go down, which means I will not be able to sell it for $1.50. I probably will sell it for $1.30, 20 cents less. It may not be a one-on-one correlation, but the idea over here is the selling power of that inventory, the selling value of that inventory has gone down because a replacement cost has gone down. And we need to make an adjustment for that. And that's what we call the write down. This is an example of accounting being a conservative profession where we say, if we know more likely than not, we're going to suffer a loss in the future, we need to take that loss right now. We don't wait for the future to anticipate it. So this is something that accountants are very aggressive about, saying, do not overstate your inventory or what it represents for the future. So let's look at an example how that would work. So assume that we have Kentucky TV that has the following line of merchandise. We have the cost and the market value as indicated. So we have these 4 types of merchandise, how many units we have, and the cost and the market value, that's a replacement value. So what we call market is replacement value. So flat screen TVs that the company had purchased at $600 a piece is now only $550 a piece. So I need to recognize it at $550 and not at $600. So I'm basically taking a $50 loss right now. The satellite radios, I bought them at $90. I can now, if I had to buy it again, I'd have to pay $104, which probably means I could sell it for a lot more than $90. Now note over here, I'm just going to leave it at $90. The conservative principle says if there is a potential loss, I take it right now. If there are gains, we have to wait for it to be realized, which means I actually need to make a sale before showing any gain. So I leave that at cost. Blu-ray players, again, market value is $48, which means I can buy it $2 less than what I already bought it at. I need to take that loss right now. The CDs, I bought it $5, and I have to, if I wanted to buy it again, it's $6. So I leave it at the market value. The idea over here is we are choosing the lower of the 2 numbers, the cost that I already had in my books, or the replacement cost, which I'm calling market, that is at December 31st at year end. Okay, so this is an idea of how conservative the accounting profession wants to be, saying that if your inventory potentially is not going to sell for the price you think it's going to sell at, you need to take the hit right now. Okay, lots of risk associated with inventory. Just carrying that inventory with you. This is something you will learn in your operations research and operations management classes in terms of what's the optimal amount of inventory you need to carry. In accounting, we're just worried about how to do the accounting. But all this information is taken by other disciplines within business to make decisions, which is why it's so important that we do things correctly over here. So what are the main risks that you have with inventory? I may have very high levels of inventory, there's a risk associated with that, or I may have very low levels of inventory and there's a risk associated with that. So what are the typical risks that you're looking at? If your inventory you have at very high levels, all kinds of problems. First of all, you got to pay to store it. Interest cost, basically the money I spent on buying this inventory, it's just sitting over there with me. I run the risk that this inventory may become obsolete. If I don't sell it quickly enough, the value of that inventory is going to go down. I will not be able to sell it for top dollars. And of course, anything that's a fashionable item, if those fashions shift, I'm out of luck. So these are all the risks associated with high inventory. So we could argue saying, well, why not just have low levels of inventory? The obvious risk that you run over here is you're going to lose sales. If there's a demand for the product and I don't have it, the customer is going to go somewhere else. If they want to buy it, they're not going to wait around for me. So I've lost those sales. So these are really critical tasks that the management has to make decisions on, all of which have a bearing on finances. So something else that you need to look at over here is ratios that are calculated, again, for decision-making purposes. There are 2 important ratios we're going to look at. One is inventory turnover ratio, cost of goods sold divided by average inventory. This tells me how often I turn over the inventory. So let's do a quick review of this word turnover. If I talked about labor turnover and I say that a business has high labor turnover, that's not good. It means a lot of people come to the business, join the business, start working, and they leave. Lots of problems associated with that. I have to constantly be recruiting and constantly training, and they're leaving. There's something wrong over there. Now for inventory, do I want a high turnover or a low turnover? Obviously high, because I want the inventory to leave me. Unlike labor, I want it to sell. I take that number And then I come to the next one, which is days in inventory. 365 is the number of days in the year divided by inventory turnover. So let's look at a quick example with Walmart and compare it and use all of this ratio analysis you use, compare it with someone else to see how you're doing. So let's look at the example over here. Walmart, the amounts are in millions of dollars. The ending inventory in 2014 is 44,858. In 2013 is 43,803. I need these two numbers because I want average inventory. So I add up the two ending inventories and divide by 2 to come up with a simple average. And cost of goods sold for the current year is 358,069. As long as all these numbers are in millions, I can drop those 6 zeros. I don't have to worry about it. So again, let's look at the inventory turnover for Walmart. Cost of goods sold divided by average inventory gives me 8.1 times. That's how often my inventory turned over in the year. Now I compare it to my performance last year. When I'm talking about my performance, I'm talking about Walmart. I'm Walmart. In 2014, it was 8.1. What was it in 2013? It was 8.3. It was slightly higher. So that's not a good thing that it has dropped. I compare my number, 2014 number, with my closest competition, and that's Target. Target is 6.1. So obviously we have done much better than Target. We are 8.1. But when you look at the industry average, it's 8.4. Now this could be a little misleading. Walmart is the industry leader as far as a retail business is concerned. So whom the business has better results than Walmart? If you have looked at the retail business, Walmart's closest competition in terms of dollar is Target. However, you know the profile of those customers are different. The profile of Walmart customers, if you wanted to do a comparison, it's really the dollar stores. And they have a very high turnover of inventory, very, very high. So let's look at days in inventory. So for Walmart in 2014, it was 45.1 days, which means it's taking them approximately a month and a half to move their merchandise. Last year it was 44, so it went up by 1 day. Now if you compare to Target, Walmart was 45 days, Target is almost 60 days. So obviously Walmart is doing a whole lot better than Target. Again, industry average is much lower. For most dollar stores, they're looking at a 1 or 2 week turnaround for their merchandise. They're not going to sit on it for 45 days. They don't have money like Walmart. Once again, remember, any inventory that you have, that's cash that you have tied up. That's the reason you want to move that merchandise as quickly as possible. So if you're going to be a finance major, you'll be doing a lot of ratio analysis, and that's basically looking at financial statements and trying to tell a story about what's happening in this company and what's most likely going to happen in the future. So moving on, let's see what happens if we make a mistake. Mistakes happen all the time, but what's the consequence of the mistake over here? So our focus over here in this chapter is on inventory, and let's look at what kind of inventory errors we could make. Common mistake is we don't count properly, the physical count of inventory. The price that I use may be incorrect, so I made a mistake. Price of inventory being incorrect, there are far fewer these days with computers, but counting of inventory is still a human task. So there is a potential to make a mistake over there. Not properly recognizing the transfer of legal title of goods in transit. Recall what we did in the previous video, the first two learning objectives. We talked about in the first learning objective, at what point do I call it my inventory? So if I've called something my inventory and counted it when I should not have, or I didn't count it when I should have, I'm going to throw all my numbers off over here. Errors affect both the income statement and the balance sheet. Again, recall, when you make a purchase, your journal entry is inventory debit, accounts payable credit, cash or accounts payable credit. So you're affecting assets and liabilities in that journal entry. When you sell your inventory, your journal entry is accounts receivable or cash debit, sales credit, and then inventory debit, cost of goods sold credit. Those are income statement and balance sheet accounts that are getting affected. So if you make a mistake with inventories, there's lots of different places these mistakes happen. So how do we correct them and what do we do with this? Let's see. The inventory errors affect the computation of cost of goods sold and net income. Beginning inventory plus goods purchased minus ending inventory gives you cost of goods sold. So if you make a mistake in goods purchased, it's going to flow through. If you have a mistake in beginning or ending inventory, it's going to flow through. Now also remember, net sales minus cost of goods sold gives you net income. So if you made a mistake over here, you now have a mistake with cost of goods sold, which means you'll have a mistake with net income. Net income is transferred into it's closed out to your retained earnings, which is in the balance sheet. So it's flowing through into your balance sheet, this mistake. So if my beginning inventory is understated, let's start with understated. If this number is smaller than it should be, my cost of goods sold will also be understated. If cost of goods sold is understated, your net income will be overstated. So it's basically a flow-through problem. I made one mistake over here, and it's now affected two more accounts. Okay. Inventory errors affecting the computation of cost of goods sold and net income in two periods, if it happens in two periods. An error in the ending inventory of one period becomes the beginning inventory of the next period. So that's going to cancel out the error. Over a 2-year period, they're going to offset each other. That's nothing to be happy about. It basically means in 2 years you made a mistake, and we need to correct those mistakes. Ending inventory depends entirely on the accuracy of taking and costing inventory. Again, something we had talked about in the first two learning objectives. It's extremely important that we do an ending inventory count and make sure everything is accurate. If not, we're now seeing the kind of problems we could have. So let's see what happens in the balance sheet. The effect of inventory errors in the balance sheet is based on the accounting equation. And obviously, we remember our accounting equation to be assets equals liabilities plus owner's equity. So errors in the ending inventory have the effects that we'll explain now. So remember, your ending inventory could be under or overstated. So if your ending inventory is overstated, assets are overstated, obviously, and your owner's equity will be overstated. If it's understated, assets are understated and owner's equity is understated. So we're assuming there's no effect on liability over here, that liability is not in any way affected over here. That could also be, but that's a more complicated issue, which we don't address in this particular class. Now, once again, trying to finish up this chapter, let's look at, is there a difference between how we do accounting for inventory using US GAAP versus the International Financial Reporting Standards? And there is a difference. So the difference is, when we looked at that valuation at the end of the year, we know how to value with using cost. Now we're comparing that with the market. Market we defined as replacement cost. Let's see what IFRS does. IFRS defines it at net realizable value. We define it as replacement cost. So that's a big difference in the two. Again, when you get to intermediate accounting, this is dealt with in great detail. Right now, you just need to know there is a difference. Also recall, IFRS does not allow the use of the LIFO method. The US GAAP allows the use of the LIFO method. So with this, we finish our chapter, the lecture series, and we can get started in the next video with working on a few exercises. So I shall see you in a few minutes working on few exercises.